All right, well, good morning and welcome to our Young and Partners Forum presentation on life science venture capital, past, present, and future, past, current, and future, I guess it's called. As most of you know, Young and Partners is a boutique investment bank. We're focused on life sciences and chemicals companies, and we provide a number of services, including private placements, mergers and acquisitions, financial advisory, and corporate strategy for those life science and chemical companies. Our panelists this morning are two of the leading life science venture capitalists from two of the leading life science venture capital firms, Cary Pfeffer from Third Rock Ventures and Ali Behbahani from NEA Associates. And I'll give a brief introduction and then I'll ask of each of them and then ask each of them maybe to briefly introduce their firms and what they do and what they look for in companies. First, Cary Pfeffer is an MD and a partner at Third Rock Ventures, which he joined in 2007. He has more than 25 years of business and transaction experience, along with biotech management and business development, as well as executive management experience. He leads Third Rock's business development efforts and has assumed active leadership roles in a number of their portfolio companies. Prior to this, he spent 10 years at Biogen in a variety of roles, and then he founded a boutique consulting firm before he joined Third Rock. He has a MD. This will actually be a little familiar because Ali also has an MD from the University of Pennsylvania and an MBA from Wharton. And Cary has a BA as well in biochemistry from Columbia University. Ali Behbahani is also an MD and is a general partner of NEA Associates and also joined there in 2007. Prior to this, he was a consultant in business development at the Medicines Company, and before that was a venture associate at Morgan Stanley Ventures. As I mentioned, he has an MD from the University of Pennsylvania and an MBA from Wharton, as well as a BA in biomedical engineering, electrical engineering, and chemistry from Duke. And with that, I'm going to ask Cary first to tell us a little bit about Third Rock.
Yeah, sure. So thank you, Randy, for inviting me and giving me the opportunity to speak to the group here. So yeah, as many of you know, Third Rock has been around now since about 2007. That I joined at the front end of the firm when it was founded, and it was founded, as you guys may remember, from the executive team at Millennium, Mark Levin, Bob Tepper, and Kevin Starr. And it was really founded on the notion at the time, and this is going to sound different than where we are today, but it was really founded on the notion at the time that there was not a lot of sort of early company creation taking advantage of the explosive innovation that was going on in science. And so that was really the notion. We wanted to build a firm that was going to do company creation and take advantage of the great innovation that was taking place. And so we've done that, and we've spent the last now almost 14 years, sort of building the firm. And just to give you some statistics, I mean, we're now working on our fifth fund. We've got about $2.7 billion under management. Our current fund is about $770 million, and we're literally right in the middle of that. And most of the investments that we do are companies that, we build ourselves or help entrepreneurs build. We always bring in great entrepreneurs, great founders into every one of our companies, whether they started the idea or the idea came from us. We always do that. And I can talk later, more about sort of what we invest in, but we invest in life sciences. We're very much focused on the therapeutic side, and we invest across areas. We're not, sort of wedded to only oncology or only, particular areas. We really go where the science leads us, and we also have taken some opportunities in the diagnostic space, once again in life sciences, or in the device space, also obviously focused on life sciences. But our bread and butter is really very much so on the therapeutic side, and we tend to invest a fair amount of money into every company that we do. So even in something like a $700+ million fund, we'll probably build in the range of about 10 companies, not more than that. And you know, we can talk later about why we do that as well, and what we think the advantage is, and how we perform once a company is launched. But that's effectively what we do. We have, I'm just looking at the list here of other things to cover. We have a fairly large firm. Because we're very much focused on building companies. We have a lot of people in the firm who help with both ideation and on the operations side of building the companies. So we actually have over 70 people in the firm, you know, helping us in all different facets of kind of what we do. So, and we're focused in the Boston, Cambridge area, but we do have a small office on the West Coast in the Mission Bay area, and we, you know, we build companies there as well.
Terrific. Allie?
Thanks, Randy. Pleasure to be here. So I work at New Enterprise Associates. We're one of the oldest and one of the largest venture firms. So we're currently investing NEA 17. It's a $3.6 billion fund geared towards both investing in tech and healthcare. I only focus on the healthcare side here, and the mandate's fairly broad. We tend to be you know, therapeutic area and sector area agnostic, but you know, the primary focus is biotech, but we also do medical device, healthcare services, and healthcare IT investing, and we'll invest across all stages. So we don't do a lot of company creation like Cary and Third Rock do, but we will, you know, about half of what we've traditionally done has been in the seed Series A kind of financings, and then we'll also do later stage private financings, and we also will invest in public companies as well. So fairly broad mandate in terms of sector and stage, and again tend to, you know, partner kind of with companies and entrepreneurs across all of those stages of a company's life.
Very good. And you're nationwide, worldwide. How many offices do you have now?
Yeah, so you know, really, it's interesting. We've always been bi-coastal. So you know, two of the founders, one of, you know, were on the East Coast. One came out of T. Rowe Price, the other from Alex Brown, and then the third founder, Dick Bramlich, was based out in San Francisco. So we've always been in the DC, Baltimore, San Francisco area.
Mm-hmm. Terrific. Well, great. Well, thank you for that. In terms of the current life sciences environment, I think many on the Zoom will know that 2020 was a record year in many ways. There were $17 billion of funds raised in healthcare venture capital last year, which was a record. There was $52 billion invested in the US and Europe, and an additional $12 billion in China, again, in healthcare venture capital. Approximately half of that, about $25 billion, was in biopharma, $11 billion in health tech, which has become, you know, much bigger over the last several years, $10 billion in diagnostics and tools, and $5 billion in devices. You know, I guess the question really is, how do you view kind of where we are right now in the healthcare venture capital environment? Are you seeing more or fewer investments than usual? You know, what categories are kind of the hottest? And maybe start with Allie this time.
Yeah, I mean, I would say it's been a pretty fluid, dynamic market, and it's every time I think it's, you know, either going to slow down or it can't get crazier, it certainly seems like it's gotten crazier. So, you know, I think, you know, it's been amazing to think, you know, looking back kind of in March or April of last year. I mean, my you know, and you're seeing the Dow drop, you know, 2,000 points. You know, my sort of thinking was, okay, well, finally, like things are gonna, you know, after 6, 7, 8 years of an epic biotech IPO market, finally things are gonna slow down. And then you had like Zentalis and Oric, and you know, some of these companies go public, and you know, presumably like the worst time that you could ever imagine to go public, and they actually did well, right? And I think what you've seen is, you know, that sort of cadence then, you know, kind of kept in the biotech IPO side, and that's really bled into the private financing side. And so, I mean, I would say in the last year, I mean, that where you've seen the most activity have been in, you know, what's, you know, being called crossover financings, right? Where, you know, it's, and traditionally it's moved upstream, right? So before it was sort of Series C and on, where you'd see kind of public investors doing private financings, you know, in that pre-IPO round. And then, you know, in the last 6 months, you've started to see that migrate to Series Bs, financings being crossover rounds. And I mean, in the last month, I've been hearing of entrepreneurs coming in, raising a Series A, wanting to do a crossover round, which that to me, I don't even really understand, but that I think it just sort of speaks to kind of how fluid the market is right now. I mean, certainly there's been some softness on the public side. I think kind of like what we saw in 2015 and 2018, it'll be interesting to see are those, in those periods, the softness was sort of short-lived, and then, both the private and public markets sort of kept on going. And I think, we're sort of in the midst of this softness, and it'll be interesting to see, is this sort of, going to be permanent, not permanent, but, more long-lived or short-lived. And I think that's going to really dictate where the private financing market goes, depending on the answer to that question.
Terrific. And Cary, what are you seeing these days?
Yeah, I mean, I agree with a lot of what Ali said. Obviously, I think the markets on the venture side for sure in life sciences have been crazy, and there's a ton of money and a ton of investment. I mean, I actually think it's been, I think, mostly driven by the innovation that's out there. I mean, I mentioned before, when we got started in 2007. And I wasn't looking that closely before then, but there was just a ton of innovation going on, and the pace of that has only increased. I mean, it really is tremendous the way science is moving, and the way there's now sort of, it used to be there, you were a scientist working in a lab, working on something, and, maybe somehow you would end up starting to, think about, hey, could this be a company? And now everybody's doing that. I mean, it's part of the language in the, in the universities, in the medical centers. I mean, I can tell you, I actually, I'm involved in a course that's taught at MGH, and it's specifically taught to physicians who are interested in translation, that is translating their science into the commercial realm. And I think MGH is not the only one that's doing this. I think it's sort of across the board happening. So there's a lot of that going on. There's a ton of innovation. Science is moving. I think there've been I mean, we in our own portfolio have 55, 56 companies, and we, over the course of the last almost 14 years now, have 16 products that are on the market from our portfolio. That's incredible. I think any pharma company would be, and I've heard this from pharma companies, would be sort of excited to have that kind of record, right? Over 14 years having 16 products. So to me, I think a lot of it is driven by, innovation, and there's a lot of excitement around it. And and I think that's all great for patients, ultimately, which is fantastic.
Yeah. What impact did you guys see from COVID-19? I mean, did that lead to new investments, or I know it had an effect on clinical trials that were ongoing in some of your portfolio companies, but how would you say the last year has been affected by the pandemic? And maybe start with Cary at this time.
Yeah, I mean, I would say that the biggest impact is what you said, Randy. I mean, we've seen a lot of impact on clinical studies, which has been, which has definitely slowed some things down, right? Because especially small companies, that's the biggest investments. Those are the biggest investments we make, ultimately, and that definitely can hurt, right? I mean, you slow a clinical trial down by 6 months or a year, and you're really sort of cutting into the company's burn rate and capital. I think that people have been understanding. We've been able to sort of manage through all of that. On the earlier research side, every one of our companies has, I think, done a really good job in general of managing through how to get the science done. We've had sort of skeleton crews, we've had all sorts of rotations. Every company's done it a little bit differently, but in general, I think we've managed to get the science done, which has been good. So I don't think there's a huge impact there. A little bit of an impact working with CROs. I mean, CROs in certain places had been impacted, certainly early in the pandemic. A lot of the Chinese CROs were impacted. And so that created a little bit of a blip in terms of getting stuff done. We personally, we've seen, and in fact, we're working on one right now. We've seen some ideas come out of COVID in terms of just sort of, new company creation. There's a ton of data that's been created that, we're sort of thinking through how one might utilize that data for, other therapeutic ideas. So there's that kind of thing that's come out of it. But, look, overall, obviously, it hasn't been a good thing. It's been challenging overall, but I think people have sort of risen to the time and managed through it.
Yeah. And Ellie, have you made any investments without actually meeting the company at this point, or how is that? How has that worked?
That's been interesting to at first, I think we, and kind of going back to April, the idea of like investing without ever actually meeting the person seemed just crazy, right? So, and I would say, I mean, at the beginning of sort of the COVID period, I mean, we probably, the pain was sort of different for different companies, right? So, I think Cary is spot on. The companies that were commercials, certainly, I mean, that were in the clinic certainly had some impact. The companies that were commercial had even worse of an impact, right? Because all of a sudden you went from, doing like 3-4 million revenue a month to, like, I remember in April, a couple of our companies were down to like 100,000 literally within a month, right? And so like there, the pain is, was even worse, right? Because they went from thinking that, like their cash requirements were not that significant to all of a sudden, like they became significant. And, the beauty of at least clinical stage or preclinical stage biotech is you're always burning money, right? So, that it's not like you have a revenue line that gets turned on or turned off. So it's all relative, I think, but coming back to your question, I mean, so that made us, I think, certainly on like seeing some of our commercial stage companies, be impacted significantly. We did retrench for, a month or so. And then, you sort of learn to adapt, right? And we all started doing Zoom meetings, and then before it, long, like I think we all sort of looked each other in the face when we were, looking at a few investments, and, and I think the question was, were we going to do this without actually meeting the entrepreneurs? Now, having said that, like the investments that we have made, we actually had met the people beforehand, right? Or, like we had seen the company in like a previous round, or, we knew some of the investors, right, who had created the company. And so I think there it became a lot easier. So, I would say, we have, most of the investments we've made in the pandemic era have been mostly in things where there is a hook, right? Whether we know either one of the co-investors or the founders, or we know the entrepreneur from before, there's something that you can grab onto. We have made investments where we didn't know the people at all, but I think it's really hard. I mean, there you tried to, in some respects, trying to do Zoom and trying to really, because making the investment's the easy part, right? You have to live with the investment afterwards for, can be a long time, right? And so, you really, it makes it really difficult unless you really know the people. But I think predominantly, most of the things that we've done post-COVID there has been a hook of knowing someone as part of that, and that's made it easier.
Mm-hmm.
Just an experience maybe to mention on my side. I mean, one company that I was involved in that we were trying to launch was a company called Phase Medicines back a little while ago, and I was the interim CEO of that company at the front end, and we were trying to syndicate the Series A because we were raising $80 million, and so TRV was putting in the range of $45-50 million, and we were syndicating the rest. And so I was actually on the other side of it, where I was, we were presenting to a bunch of other investors, and it was all over Zoom, and we ended up closing the round completely under Zoom. I don't know that we've actually formally, I mean, obviously some of the folks we knew, but in terms of the internal team, I mean, there is obviously a permanent team there. I'm not sure that they've actually met many of the board members face to face yet, even though we're now a launch company. We've started, we actually have a full-time CEO now, et cetera, et cetera. So it's weird. I mean, it really is weird. I would never have imagined that we would do that either. But, as I said, I mean, some of the people we knew, some of the people we didn't know. The CEO that we hired, we actually knew from previous discussions that we'd had years ago. But even in that situation, I mean, I actually, went and met him at an outside venue for a couple of hours just to spend time and just really sort of make sure that, it was the right hire. So, you make do, you figure it out, but it is weird.
Yeah, very good.
Yeah. I would
ahead, Ali.
point to I mean, it was really, I think, the public investors that, kind of opened my eyes, right? I mean, the fact that they were doing these virtual, you took a roadshow that was a week and a half on an IPO and you made it, 3-4 days all virtually. And, and like there were deals being done and they were doing well. And so that made me start to say, all right, well, maybe this isn't as crazy, but it's hard. I mean, you certainly, I think, it'll be interesting to see if there are, and I haven't heard any, but like the negative stories of just doing a Zoom only sort of investment and what happens. I mean, I'm sure that will happen and that will come, but it'll be interesting to see what if that does come to play.
You can move much more quickly. That is true.
Yeah. Yes, you don't have to go, not everybody, get everyone together the same way as you used to. Well, good. Well, why don't we talk a little bit about how you've seen the life science venture capital environment change over time? What have the drivers been? I mean, I assume things that obviously you've talked about innovation, Cary, and I assume things like the FDA's attitude towards different types of companies, the competitive environment, and clearly the IPO and M&A markets as an exit, probably all are drivers, but maybe talk a bit about how you've seen it change over the last time. I guess you both started 14 years ago, so that over that period, how about, and Ali, why don't we start with you first this time?
Yeah, I mean, I would say, I started my venture career at Morgan Stanley Venture Partners on July 5th of 2000, right? So this was just right after the tech bubble had kind of burst, right? And that Monday, I want to say we approved like 15 deals, and then the Mondays following after that, there were like 0 deals, right? And so, it was always sort of interesting to me that when the market stopped, it came to a halt, right? And you sort of saw that happen in 2008-9, right? Similar sort of circumstances. I think what's really different now is, this kind of, if you want to call it an IPO window, has been the longest that I think we've ever sort of seen, right? I mean, I think you can kind of maybe say, all right, well, in 2015 and 18, there were maybe times where it kind of slowed down, but it's been a stretch of, call it 6, 7, 8 years, right? That it's been going on, and I think that's really impacted how the private market has sort of evolved as well. And so, it's not, you're seeing larger Series A's, larger financings, just generally, you're seeing a lot more investors coming in. You're seeing a lot of, public crossover money coming into the space. And I think that's really what's changed. I mean, the people who are doing the seed Series A's, I mean, that's been relatively constant, and the valuations may have crept up a little bit, but it's been fairly steady. And the people who are doing the company creation, like Cary and Third Rock and Versant and others, I mean, most of those players are all the same. I think really what's changed is the volume of capital and that, Series B, Series C crossover type financings, and that sort of has ballooned, and it's kind of kept on increasing over the last 6, 7 years. And I think the real question is, okay, well, if this, and Randy, you and I worked. I remember when I was an analyst at Lehman, and it was like 2 in the morning, and this was like during the tech bubble, and I remember Fred Frank was there, and I was talking to him, and he said, well, and I said, well, maybe this is just a fundamental change in kind of how business is done, and like, this isn't like a bubble or anything like that. And Fred was like, well, that's not the case. Like this will come to pass as well. Like all good things usually come to an end. And so, but it has been 6, 7 years that the biotech market has been kind of, IPO market's been going. But at some point I have to imagine like it'll at least slow down or be different. And then the question is, does that pool of capital in the Series B crossover space sort of decrease, go away? And I think that's the part that's a little bit hard to know. But it's a great time for companies. I think great time for innovative science, where you can take something that things are even 4 years away from a clinic, that are able to get funded. Exciting science, exciting new platforms that would have struggled to get funded in 2008 or 2009 are able to raise capital, and a significant amount of capital early on.
Cary?
Yeah, I think look, a lot of things that Ali said, obviously I agree with. I'll mention a couple of just a couple of trends that I've seen over the time. So first of all, interesting to note, when we got started in 2007, the end of 2007, there was actually, as I mentioned, there was no IPO market. I mean, it was literally people sort of, I think, scratch their head a bit about, wow, getting a new fund started, no IPO market, what are you guys doing? But there was certainly a little bit of that, and it was a bit contrarian, but so we assumed at the time that a lot of our sort of liquidity exits would come from from M&A, candidly, and it turns out it's been exactly the opposite. We have, if I look at sort of all of our liquidity, all of our exits, it's probably 2/3 IPO, 1/3 M&A, and so that's just been an interesting shift in kind of the way we think about it, and it has actually had impacts for us across the board in other ways. We've had to think about, okay, public company stockholders, how do we manage that? Which is something we never, we actually just, we assume we'd have to do some of it, but not at the scale that we do. So that was just an interesting thing. The crossover dollars that Ali mentioned, completely agree. And that maybe this was mentioned before, but when back then in the 2008, 9, 10 timeframe, crossovers were just, I think, starting to, public investors just starting to sort of get involved in the Series B, C's, whatever, just the rounds just before going public. Now, as we see, we go talk to crossover investors when we're syndicating a Series A, and they come in. Obviously not in everything, but they certainly come in, and they're excited to sort of goose their returns by getting in at their earlier stage, lower prices, etc. And I think in general would claim that they're having good success on that. So that's another thing. I will say, when we got started, I think I think we did sort of play a significant role in the initiation of new company creation at the time, and really sort of made that a very significant part of what we were doing, for sure. And I think now obviously lots of other firms are doing new company creation, which is great overall. We think, we think it's a great way to sort of get a handle on new innovation and move it forward. The FDA view, over the years, obviously breakthrough therapy and other things the FDA has done have been very positive, I think. And then, I mentioned this a little bit before, but the pharma need has never been greater, right? There are fewer companies, large companies at least, because there's been M&A, et cetera. But, for them to, once again, a 10% growth rate on a, $40 billion of revenue or whatever, it's pretty huge, right? It's pretty hard to manage. So in any case, I think that's a big driver as well, and will continue to be for a long time to come in our view.
Yeah, and I think, you kind of mentioned it, but I've noticed that the size of a lot of these Series A's has gotten much bigger, and I know, Cary, I know you started doing that a little bit even earlier on. I don't know if Third Rock was the first company to do that, but certainly that has been a big change, at least that I've seen. It used to feel like companies would raise 5 or 10 million. Now they seem to be raising 80 or 100 million. Do you want to comment a little bit about that and what that has meant?
When we got started, we did get started with the intent of sort of putting more money in at the front end. And initially, though, I will tell you, our view was $35 to $40 million was a big Series A, and it was. It absolutely was. I remember, Agios was a company we invested in with a couple of other, that was a syndicated Series A. And I think $35 million was the initial round. So, and that was considered a big number, right? Today, we invest easily on average $50+ million in a Series A. And then sometimes we'll syndicate and we'll bring it up to $80 to $100 million total. So, and there are folks who've invested $200+ million in Series A's as well, and syndicated those or what have you. Arch tends to put lots of money to work at the front end, obviously, and I think, at least for us, it's paid off largely because having a significant ownership stake in these companies makes a big difference. And we also spend a lot of time. We have few companies per fund, as I said, in the range of 10 to 12, but we try to work each company and get involved in each company and not have a lot of zeros. We really sort of, work very hard at every one of our companies, and I've talked more about the process we have internally to sort of do that, et cetera. But we put a lot of resource into the companies, even post the initial investment, to help them be successful.
Great. Okay, why don't we talk a little bit about exits? We've touched on it already, but the IPO market, as Ali and I guess Cary both mentioned, has been incredibly strong. I mean, 2020, record IPOs, record IPO proceeds per deal, record IPO pre-money valuations per deal. I think something like 500 million was the median in 2020 and 200 million was the median proceeds. So, just an incredibly hot biotech IPO market. And biotech M&A has been strong. I don't think we had records last year, but it's also been quite strong. And as you mentioned, there aren't that many pharma companies, but a lot of the large, what used to be called biotech companies, I don't know that they're different really than the pharmas anymore, but they also are making a lot of acquisitions. So maybe talk a little bit, and we'll start with Cary, but maybe talk a little bit about how you think about exiting your investments. When do you start thinking about it? And then, how do you look at IPOs versus M&As? Have you guys looked at SPACs? I don't know, a lot of questions, but go ahead.
Yeah, we've tried to, we've tried to build every one of our companies with the notion that we're building a great company, and that's kind of the way we talk about it. That's the way we set up the initial plan, et cetera. And I just contrast that to some folks who sometimes, build to buy or build specifically to exit or build kind of more semi-virtual type companies so that they're, sort of more easily targetable as M&A targets or what have you. We don't do that, actually. We really try to build companies from the ground up that we feel like are going to be real companies. But obviously, as we move forward, this is why, the strong IPO market has been fantastic for us. Obviously, at some point, you get to a point where you need to raise a lot of capital, and your cost of capital staying private is just too great. And so you end up, going public. And so that ends up, as I said, in 2/3 of our cases, ends up being kind of the way we've exited. The M&As have come typically later. They've come when the company is, sort of candidly closer to just, knowing that there's a drug there. Whether that's a post-phase 2 proof of concept or even starting a phase 3 or what have you. And so those have happened, but they've happened in general a little bit later. Once again, we don't build the companies to get bought, but ultimately, when there's an offer on the table, we consider it like anybody else, and figure out what the right thing to do is. So that's kind of the way we think about liquidity. You mentioned SPACs, and this has been announced. One of our companies, Tango, is has just been acquired by a SPAC, and so I think that's our first experience with an actual happening, if you will. And I think it was a very high quality SPAC through Boxer Tavistock, and and I think it's been so far a really good experience. And we're now going through the SEC process, et cetera. So we're not at the back end of that yet. We'll see, but it's been a good experience. It is, in my mind, are SPACs a fad that are going to go away in another 2-3 years? I don't know. I honestly don't know. I thought that a while ago, but I don't know if I think that now anymore. I think it is a really good option for certain situations. And I think it's another tool to have, both for the company and for investors, to have, to access significant capital at, not ridiculous cost of capital. So.
And Ali, what has your experience been?
Yeah, I think many of the same things that Cary talked about. I always go into investments wanting to build a big company and try and not to sell but along the way, just based on sort of the risk ahead or the capital required, it may make sense, right, to sell. But, I love the fact that you can take a company public and raise the capital and control your own destiny. I mean, that's the one thing I learned at the medicines company was, it's always great to control your own destiny. And so like, that's what, being able to go public is. And I think, everyone forgets how bad before 2012 was in biotech, right? I mean, just, it was not uncommon to have 50 million dollars of bridge, notes out. It was hard to get any financing done. You were in Series E, Series F land sometimes in certain companies that had been around for a while. And it would have been great to sell companies at that point, but it was like pulling teeth from pharma company to get them interested, even at any price, right? And so I think, the dynamics were a lot different. Now, with just a viable IPO market, there's the path to, control your own destiny. And I think that's really what changed biotech, right? And was, everyone forgets like those IPOs that went out in 2012, it was brutal, right? I mean, we were in Hyperion Therapeutics.
You had to invest, right? The VCs always had to put money in order to get it done, as I recall.
Yeah, I mean, there were maybe 12, 13 potential public investors, right? The VCs would definitely have to put, money in, like, and that maybe some of that's different, not that different today. But, the valuations, right? I mean, were 100 million pre-money, right? I mean, we took Hyperion public, I think at 100 million pre-money for a phase 3 asset in an orphan disease, before orphan got hot. And, and I think it was about a year and a half later that it was sold for over $1 billion. So, it was just a much different time frame. And so I think that things have changed quite a bit. And I think, for the better, right? And it allows you to control your own destiny. What does worry me is, the more money there is, the higher, the reason that Series A's are higher is the burn rates are higher, right? Even as private companies. And that's because people aren't, before you were like, okay, we're trying to be capital efficient. We would take one asset forward and then, we'd have a pipeline, but you're really dedicating 80% of the resources to that lead program. Now, we're maybe taking 2 or 3 programs forward, right? And so that increases the cost. And so the availability of capital helps on that end. But, if capital becomes tight again, then all of a sudden, you're running 80 miles per hour into a brick wall, right? And a lot of the things that people forgot about before 2012 all of a sudden become, come to play. And so there is this balance about, using capital efficiently and pushing programs forward aggressively. I think the SPAC side of things is interesting. So we do tech and healthcare. I will tell you, on the tech side, the SPAC market really opened up, the IPO landscape for companies that weren't going to be able to get public, right? So, on the tech side, it's moved that you need like 400 or 500 million in revenue to go public, but there are really interesting companies at 100 million or 200 million in revenue that couldn't go public. And I think that really, the SPAC market really started to fill a need there, providing the opportunity for companies that, wanted capital, but weren't able to access the public market. And so that really helped fill a void. I think the interesting thing in biotech is I'm not sure that void exists in biotech, right? I mean, there are preclinical companies that are able to go public anyway today. And so, it's definitely a different alternative. I feel like the need isn't quite there, but, if the market shifts, then all of a sudden that need becomes greater, right? Or in like devices where it's been hard to get public without, 30 million in revenue, there are, companies below that I think could benefit from being public and having, access to a broader investor pool. But the only way to do it is maybe through a SPAC vehicle. And so, there are different needs and different points in time where I think, things can make a SPAC more desirable or less desirable.
Mm-hmm. And one question I had, do you guys hold stock? What do you do with the stocks once the companies are public? Do you guys hold? Do you distribute? How do you handle that? Do you stay on the board?
We as I mentioned before, we actually at the very front end when we started the firm hadn't done a lot of thinking about it because we thought a lot of our exits were going to be through M&A, and so. But ultimately, obviously, we've devised a strategy and figured out how we want to manage things. And we also typically, when a company goes public, we still have a pretty significant position in the company. Sure. So it is a management issue. And candidly, what we do, and we actually talk to all of our companies about this, kind of as they're going public, is just that we we're not long-term holders. We're not meant to be long-term holders. And by long-term, I mean, we're not holding on to a company public stock for 10 plus years, right? But we certainly are not, we're also not in the business of, just sort of as soon as the lockup is done, just dumping stock. We're never going to do that either. That's just not. We don't think that's good for the company. So we typically go through a pretty disciplined process over time, and by time I mean typically several years. Of sort of exiting a company, and that's just sort of based on just as I said, sort of a systematic process that we kind of go through internally. And we do distribute stock, so LPs can then make a decision as to what they want to do in terms of holding or not as well. But that's it's a systematic process. It's disciplined, and where we always try to do what we think is going to work for the company as well as us.
And Ali, how do you handle it?
Yeah, I mean, not too dissimilar, I think, from how Cary and Third Rock think about things. I mean, we certainly, it's hard, like, all of these companies, and I'm sure it's the same for Cary. I mean, you get so invested in it, not just, dollar wise, but emotionally, and, oftentimes I do stay on the board, after it goes public, and, we try and be helpful. I mean, especially like a lot of these companies, especially if they're preclinical going public, like it's still early, right? I mean, we're just,
sure.
we're just starting, right? And the reality though is, I think what limits, it's great that these companies are able to get public, but because we wind up owning so much of it, and again, I think Third Rock probably has the same issue, right? The idea of us selling right after it goes public doesn't exist, right? Because one, the volume's just too thin. So as soon as we start selling, it's just, you wind up affecting the share price negatively, and you don't get very much out. And so oftentimes because of that, we're, when we invest, I think we're investing knowing that we're going to have to play through some sort of data card, right? Because that's really when, the volume will pick up, and that's where, there's enough where you don't affect the stock price. And, you have to be right? Because if you're wrong, it's going to be down 80 or 90% the next day. And it's always hard, right? I mean, we're investing at a very early preclinical stage, and trying to forecast whether, this drug with a team that could be different, right? Certainly will have more people and is going to work in a clinical trial that we have no idea what the design of looks like today, but hopefully you'll have the right people who will design it. And clinical trial design is a game of inches, right? Just little things here or there can affect the outcome, even if a drug works. And so it's and that's usually what you have to be comfortable playing through, because I think for us, unlike some of the crossover firms that have small positions that can get out once the lockups come off, we don't have that luxury, and we're going to have to be right about the biology and ultimately having it play out in a clinical trial, and then go from there, right? That's sort of similar to Third Rock. We sort of have the same views on that.
Yeah. Well, good. Well, I should just mention to the audience, we're going to take questions from the audience in a couple of minutes. I'm going to ask one more question of each of them, and then we'll go to that. So you should put the questions into the Q&A or chat if you see it, but certainly the Q&A, and we will get to them. I know there's already one there, and we will get to that in a moment. But I just wanted to ask Ali and Cary, and I honestly don't remember who goes first this time, so we'll go to Ali. Alphabetically. What changes do you expect to see in the future? I mean, what do you see out there? How might it change if we're having this conversation in, I don't know, 3 to 5 years? Or are you seeing things that might be, might be very different?
Yeah, I mean, hard to say. It's always I feel like it's always a geopolitical thing that changes the landscape, right? That none of us can control. So I agree that like innovation seems like that's going to continue. There's, it's amazing to me, like what you can do today that you couldn't 6-7 years ago with these like new therapeutic modalities, right? So I think the innovation stuff's going to continue. It's always the existential question. Okay, does the IPO market slow down or go away in some form or fashion? And I do think it's usually it's some geopolitical thing that none of us can forecast that happens, right? I mean, there's certainly I think worries about drug pricing. I think and so certainly that can come to play. I think there's worries about, okay, is the FDA sort of stance and changing in terms of being a little bit more on the conservative side. Hard to know, right? I think all of those things, are just sort of par for the course when you're a biotech investor, and you just have to adapt and play through it. And so, so to me, I think the the front end part, the innovation part is going to continue. It's the, will the capital markets, the amount that we're able to raise, the cost of capital, will that change dramatically? And if it does, then I think we're all going to have to adapt in some form or fashion. If it doesn't, then it's probably more of the same that it's been for the last 6-7 years. And I mean, candidly, like, I thought things were going to change 3-4 years ago. So I'm absolutely the wrong person to ask that question. But maybe Cary has a better viewpoint than I do.
Fair enough.
So I mean, I agree with everything Holly said. I think, with regard to the markets, I don't have any better crystal ball than anybody else. I mean, I think, if you just look historically over time, there's certainly been ups and downs, right? And we've seen that. Will there always be as much capital available today as there has been? I don't know. I mean, I hope so, only because I think it's great, not just for the industry, but I think it's great for patients ultimately. But I will say, I do think that, company creation will continue. I think that people are generally excited about that. And as I said, I think it's actually really made inroads into the universities and the PIs in terms of just sort of what they can do. And that's, I think, an exciting thing. The one thing that I'll say, and I do think that the pharma need will continue and innovation will continue to support that. I think that those are definitely going to continue, if not increase. The one thing I'll add, maybe that's something a little bit different, is, the areas that have gotten the most attention recently have been sort of those areas where there's a little bit reduced biological risk, and those are the areas where there's sort of more genetic definition, right? And so people always talk about oncology, and it is true that in oncology you can genetically define targets and patient populations, and it truly does decrease risk. I mean, there's no question about it. And I do fundamentally believe that there will be a time in the not too distant future, and I don't know what that means, but in the not too distant future, where there are going to be other significant areas that the biological risk will also be reduced because of some, sort of definition of patients and mechanism of action. We've looked at lots of different areas. I think, that maybe that's happening in the immune space, the autoimmune space. Maybe, I mean, it's starting to happen in certain neurological diseases, schizophrenia, for example. There's a lot of genetic data now. We're not where we are with cancer on any of those yet, not nearly, but I do believe that those will continue, and that reduction in sort of biological risk is going to, continue to sort of enhance investment in areas outside of oncology.
Interesting. Well, good. Well, we will take some questions from the audience, and the first two, one from Mohan Iyer and from Judith Kelleher Anderson, are both really about Series A's, and the question about whether how is it good for the companies to be raising so much money, and aren't these founders getting highly diluted by these large Series A rounds? And how do you think about that? I know, Cary, since you're generally starting companies, you probably would end up with higher percentages maybe than Ali would in some of his deals, but maybe I'm not sure. So what do you think? I don't know if you can read the question on the Q&A, but it's what do you see as the pluses and minuses of these very large Series A's?
Look, I mean, so I think it's a good point, and like anything in life, it's a balance, right? I think it used to be, and we used to talk about this a lot when Third Rock got started. As you mentioned before, Randy, companies got started with $5 or $10 million in a Series A.
Right.
We used to talk about that as, a bridge to nowhere, because you can't do enough with that much money in a company to have any kind of significant impact at any kind of significant milestone. On the other hand, if you raise $200 million, sure, you're right. I mean, there is a fair amount of dilution, and is that really the right thing to do? So I think ultimately, it is a balance, and we're thinking carefully. We think for every one of our companies, it's not a cookie cutter approach. We think carefully about where is the right next milestone upon which we're going to be able to raise additional capital, and how much of an uptick will that get us in valuation, and and then what's the risk of getting there, and thinking about, okay, so that means we're going to put in X amount of capital to get us to, to that place and give us a little bit of cushion, et cetera, et cetera. The flip side of not raising enough money or significant Series A's is, you're stuck in a situation where you haven't quite hit your milestones. You're trying to raise a Series B. You really still believe in your science, and yet it's hard to prove. And so you then go ahead and raise a Series B. And this, for me, has been the toughest spot, I think, in investing over the course of the last bunch of years. I think, that second round, especially from a target discovery company, that second round of investing is tough. And unless you've really hit some milestones, and you can get clobbered on valuation. And in that case, I'm not sure it wouldn't have made sense to raise $200 million at the front end when you could, as opposed to taking a 50% cut on your series, off your Series A price in your Series B. So it's a balance, and making that call is not always so easy. It's judgment.
Yeah, I mean, I agree with that. I think the trickiest, one, not raising enough, right, to hit the milestones, as Cary pointed out. I think that's spot on. I mean, the other is raising too much, and if the burn rate increases, that incremental dollar that you're investing, you're getting a lower return on that investment, and you start to kind of spend a lot more loosely in terms of saying, oh, we don't really need this person, but we have the cash, why not hire them, right? And you start to, like, those decisions start to add up, right? And before you know it, you're kind of sub-optimizing your outcome because your burn rate's high. You wind up overspending, maybe not getting to kind of the milestone that you want, and then you're in a tough spot, right? And I think those two are the bookends, and the right balance is somewhere in between, right? Something that allows you to make meaningful progress, move aggressively and fast, but not so much that you're just burning capital and inefficiently. And I think that's how I sort of always think about it, and that's what worries me about some of these much bigger rounds, right? That also worries me about, like, the undercapitalized rounds. And so I think there is a balance, as Cary points out.
Yeah. What is there kind of a typical ownership percentage that you guys look for? I mean, that's being asked in the Series A rounds these days.
I mean, it really depends, right? It depends on the size of the raise. And I mean, typically, this is kind of where, for us, like, the crossover stuff has gotten hard, because if we're not going to have meaningful ownership, and for us, like, meaningful ownership is 20% or more, right? That, to move the needle in a $3 billion fund in normal sort of outcomes, anything less gets hard, right? And makes it less meaningful for a large fund. That's the blessing and the curse for us, right? And regardless of if it's a $500,000 investment or a $50 million investment, like, it takes the same amount of time, right? And so I think those are sort of the things that we tried to think about. And and as the valuations in some of these later stage rounds, which we used to participate in a lot, have gone up, it's getting harder to make that math work. And so that's pushed us. And I mean, in NEA 17, I'd say historically about half of what we do is seed Series A investment. In NEA 17, which we closed in April of 2020, all of it, all 11 investments that we've made have been seed Series A, right? And I think that's a function of like the prices at the Series B's and on just being just too high to sort of indirectly ties to ownership. But that's how we usually think about it.
Yeah, I mean, I guess the thing that I would add to that is a lot of times we don't necessarily look at, I mean, ownership, obviously the Series A is important. We do focus a bit more probably on what do we think we're going to own at the IPO, for example. And and candidly, for us, that's a high number. We're looking to be in the 30 to 40% range. I mean, we used to say 40% and above. That's gotten a lot harder, candidly, for probably all the reasons we've talked about. But certainly, we don't want to be in the 15 to 20% range at the IPO. I mean, does it happen sometimes? Sure. I mean, and we may make that decision consciously, but we're looking to be, in that sort of 30 to 40% range at the IPO.
Yeah. There's a question here from Brandon Cashman about M&A exits, and what trends are you seeing there, particularly for late stage, either phase 3 or products that are on the market? is there a lot of competition for that, or how is that? How have you seen those companies treated?
Go ahead.
I mean, my like M&A, I think is always hard, like regardless of where you are in stage. I mean, certainly if it's preclinical and you can sell the dream, it's one thing, but then, anyone that has any shred of data, and I actually think this is true for companies raising private financings and public financings, right? If you're preclinical and you can sell the dream, it's great, right? And because people in their mind go to think and say, okay, well, this is definitely going to work, right? That's sort of human nature. But as soon as you get any shred of data, like that data will be picked apart. And I've seen it, whether it's public investors, private investors, pharma companies, like you will just get shredded, right? And because at the end of the day, like data is never going to be perfect, right? And so, I guess, so I guess my sort of view is like anytime you have data, it's always gonna, there's always gonna have to be an explanation, right? And regardless, of who you're talking to, and then it just depends on the strength of that data. But I do think, as Cary pointed out, like people want later stage products, right? And so, if the data is compelling, I think that company will have an easier time. If the data is mixed, or you have to kind of, tell a story and get people to believe that story, then it's going to be harder. And then it just depends on therapeutic area and need and all that.
Yeah, I don't have a lot to add. I think that's exactly right. I think it does depend on the area, and if the data is compelling, and you want to sell the company, you're probably going to be able to do that. If the data is mixed, then as Ali said, I think that can happen a lot. I mean, we've had data in the past that we thought was really compelling, and ultimately it got ripped to shreds by everybody, and it ultimately wasn't as compelling as we thought, or at least that's what other people thought. So, and it sometimes gets really hard. But if the data is really compelling, then I think you can probably sell what you want to sell and do pretty well. So.
Yeah. Have you seen, I mean, it seems to me that, a lot of times when we see these M&A deals that it starts with a pharma company coming to the biotech. Like it doesn't usually start with the biotech saying, okay, we're going to send out a book to everybody and try to sell the company. What has your experience been on that?
I think that's generally right, except in a different situation whereby the biotech company was out doing partnering and talking to folks about partnering opportunities. And then, there are times we've all, seen that where those partnering discussions could morph into M&A discussions. But I think, you're right. If anything's going to start out as M&A, it's much more typically going to be pharma approaching, unless it's a fire sale type of situation from the biotech where things are just not going well, right? So that's
right. And those are hard to sell a lot of times anyway, I think.
Right.
Yeah, it's been a while since I've seen like a formal structured process, right? That's been run by like a bank reaching, like I haven't seen that in a while. I mean, we always think about like, should we do that? But I think, generally like the feeling has been to not do that. But admittedly, my end's probably small as well. So
that's always an issue. Well, if there are any other questions, please put them in the chat. We're getting close to the end of the hour, and I really want to thank both Ali and Cary for a great discussion and for doing this, and wish you the best of luck, and hopefully that IPO market will stay hot for another 7 years or whatever it's been. That would be nice. It would allow you to do quite well, I imagine. Continue to raise more funds and build more companies. So thank you very much, and appreciate it. And I guess with that, I want to thank everybody for joining today.